The stark divide between these two groups isn't about the money they start with. Here's the truth. The real difference is a fiercely guarded psychological framework. It's how they think. They exist in the exact same market, but the reality they operate in is entirely different.
Section 1. The truth about risk.
Nobody talks about how the financial elite actually view risk. The prevailing wisdom tells you to play it safe, right? But that's exactly what keeps the average investor trapped in a cycle of stagnation. Most people see risk as a threat to be avoided at all costs. But to the wealthy, risk is something to be managed and priced correctly. It's never avoided entirely, because avoiding all risk literally means avoiding all growth. If your money's just sitting safely in a bank account, it's silently bleeding value. It's losing its purchasing power to inflation every single year. $1 today is mathematically worth less tomorrow. To the elite, absolute safety is actually the most dangerous risk of all. Just look at this stark contrast. The average investor is paralyzed by the fear of loss, which basically guarantees their own financial decline. The rich investor, on the other hand, operates with cold, calculated execution. They take risks where the potential reward mathematically outweighs the downside. And here's what truly separates the elite from the amateurs. The wealthy are totally comfortable being wrong. They don't need to win every single time. They know that being right consistently over a long timeline is the only metric that actually matters. They detach their ego from the outcome, viewing every trade as a simple equation of probabilities.
Section 2. The master of time. There's a massive, silent divide in how these two groups perceive the very passage of time. Average investors trap themselves in a microscopic time horizon. They're thinking in days and weeks. They react to quarterly earnings misses, random geopolitical headlines, or social media rumors with this massive surge of adrenaline. The rich investor thinks in decades. They understand a fundamental reality. Short-term market noise is entirely irrelevant. This single psychological shift changes absolutely everything. When you expand your time horizon, volatility transforms from a terrifying threat into a calculated opportunity.
A 20% drop. Think about what that number really means to someone who's checking their portfolio every single day. A 20% drop in a week feels like an absolute heart-stopping crisis. It triggers pure panic, and ultimately, it triggers selling at the exact worst possible moment. Fear overrides all logic, and the average investor locking in their losses becomes a permanent victim of their own anxiety. But to a wealthy investor planning a 20-year hold, that exact same 20% drop means absolutely nothing. It's a blip, just a footnote in a larger, calculated strategy. They hold steady, entirely untouched by the panic of the masses. In fact, while the amateurs are liquidating their assets in sheer terror, the elite are quietly stepping in to buy those exact same assets at a massive discount.
Section 3. The information trap. We're constantly told that information is power, but prepare yourself for a counterintuitive reality. This will shock you. The wealthy consume less financial news, not more, less. We live in an era where continuous financial news is engineered purely for urgency and clicks. It's literally a machine designed to hijack your nervous system and force impulsive reactions. The elite know this, so they ruthlessly shut out the noise to protect their execution. They understand that the media's profit model relies entirely on keeping you in a state of perpetual, fearful action. By stripping away the constant barrage of media hysteria, the wealthy investor focuses with cold calculation on the only 3 decisions that actually matter: what to buy, how much to buy, and how long to hold. Everything else is just a distraction, engineered to make you act against your own best interests. They isolate these 3 variables, ignore the pundits shouting on television, and execute their strategy in total silence.
Section 4. Surviving expensive mistakes. There's this dangerous myth that the financial elite possess a flawless crystal ball. The shocking truth is that every single rich investor has made incredibly expensive mistakes. The crucial difference is how they respond. The average investor doubles down on losing positions out of pride. They refuse to admit they were wrong, letting their ego drain their accounts to zero. The rich investor operates with emotionless amputation. When they're wrong, they cut their losses quickly. Pride is removed from the equation entirely. This creates a mathematical asymmetry that is the true engine of generational wealth. Small losses, large gains. You cut the bad trades at a 5% loss, and you let the winning positions compound for hundreds of percent in profit. You don't need a perfect track record. You can actually be wrong on the majority of your investments, and because of this mathematical asymmetry, you'll still build an empire. The math protects them from their own human fallibility. The wealthy mindset.
look closely at the source material we've uncovered in this explainer. The rich investor isn't inherently smarter. They don't possess a higher IQ or illegal secrets. They simply operate on a completely different psychological plane regarding risk, time, information, and failure. And these aren't secrets kept in some hidden vault. This exact framework is available to anyone right now. Wealth is a mindset that must be adopted long before the money actually arrives. The psychology must precede the capital.
The divide isn't about your starting balance. It's about your mind. So the ultimate question isn't whether you have enough money right now to think like a rich investor. The question is, are you willing to think like a rich investor before you have the money?